think you forgot one name, Imogen Richards, as well from Pantheon, a partner and head of, investment structuring at Pantheon, exactly. Let's start right away. I wanna start with you, Paulo. So, 2023. I was in Davos last week, and there was a lot of optimism with respect to the world. I always wanted to say that, with respect to the world economy. Yeah, exactly. Look, deal volumes are down. There was a lot of uncertainty with respect to where terminal rates will end, and the uncertainty is still there. Fundraising has slowed significantly. What's your general feeling about 2023?
Well, firstly, good morning, everyone. Thanks for having me over here, and Jan-Henrik. Look, I think it's you'll hear a lot of divergent views over the course of today, but there's obviously a lot of optimism. I was watching Bloomberg this morning, and a ton of optimism coming out on the screen and on the screens on the markets yesterday. But I think on the credit side, maybe it's just we're naturally cynical, feel a bit more cautious. Firstly, I think about that question in several ways. What are we seeing in our portfolio, for instance? We have about 22 billion invested in Europe today, and we can track on a monthly basis what's happening in that portfolio. There is some degree of optimism there. We've seen revenue growth flow through. We've seen EBITDA growth through, 18% EBITDA growth over the course of 2022. We have real-time information. Margins have stayed fairly stable, despite all the inflationary impacts that we're all talking about. But I do feel that 2023 will be cautious. The financials we're seeing are lagging indicators. They tend to be a quarter, a month, looking backwards. And there was the COVID, coming out of COVID. There's the pass-through of price that was because of inflation that consumers or the ultimate, customers were accepting, which I think you're going to see a bit more pushback in 2023. So in terms of just the macro and company performance, I think it's going to be much more muted as people catch up with the inflationary pressures. When you can't push price through, and volume demand is going to come down slightly. So that's going to create pressure on margins. We see it at every margin level, a contribution margin, gross margin, EBITDA margin, and all the way down to levered free cash flow with, by the way, higher rates on interest expense. Will create a lot of pressure on free cash flow, dampen CapEx. So I don't see a lot of cause for big amounts of optimism, but nevertheless, the big inflationary dampers on energy, the China COVID may balance that, but I think it's still a very cautious environment. I think deal flow will continue to be dampened. Stefan and Imogen can talk about it. I'm sure they will. Private equity, M&A activity, I think will be dampened. Capital markets reopening will be slow. We need that to happen for the volume, for the M&A deal-making environment to happen. But as a credit investor, speaking my own book, I think volume for us is, the demand for private credit is high. Capital markets have shut down. We're in a bit of a golden age in terms of vintages. And 2022 was one of our biggest years of deployment, nearly all of it after the advent of Russia-Ukraine.
So private credit was, to some extent, like the only game in town last year. Like deal financing was very difficult, and it's certainly getting more expensive. Talk to us a little bit about what has been, driving this growth of private credit, and where do you see the momentum at the moment?
Look, I think that's a long-term secular shift, as opposed to something that was just created in 2022 or by Brexit or COVID or the GFC. It's a long-term shift. I think of it basic supply-demand. The supply side on capital has been constrained for a long time. The commercial banking environment, the investment banking, capital markets in Europe have been volatile. So private credit, since 2007, has really filled a vacuum and has continued to grow. I mean, these dislocations that have happened, feels like every 2 years in my career, going back to 1999, reinforces the need for an alternative source of capital. So it's there. Unlike the GFC, when we were operating, there was no deal activity at all. Private equity had dry powder, but there was no private credit. In 2022, like you said, deals happened. New M&A happened because there was a ton of dry powder in private equity and private credit for the right transaction. So yes, we had private credit had boom times. You can pick and choose, you can tighten, base rates are up. When you think about 10, 11, 12% unlevered yields for first lien debt, that's very good returns on a relative basis, an absolute basis, but maybe not sustainable as you think about capital structures for for a new buyout or a new M&A transaction or a new CapEx project.
Maybe Imogen, if you jump in here, like more from an investor's perspective. I mean, the title of the panel is "Can one find value in private markets?" I think it's a bit of a rhetorical question because there's always some value. How do you feel at the moment about, just high level, about investing in private equity?
Maybe if I can give an overview of what I do and what Pantheon does. So we invest in alternative assets, private equity, infrastructure, real estate, credit. We've got over 2,000 funds that we invest in. So we've got a very high level overview of the market. And I think I'm probably in a fairly good position to then think about the themes at both the GP level and also what we're seeing at the LP level. If I take those two themes, at the GP level, we are seeing lower exits and lower deal activity. So we looked at our portfolio for the last year, and new deal activity is down around 18%. Exit activity is down around 25%. Valuation multiples for new companies that they're making investments in, the multiple around 1.3 times lower. So we're definitely seeing some of that reduced activity and reduced valuations at the GP level, which kind of chimes in with what Paolo was saying. At the LP level, we're also seeing more reluctance to invest. So flows into the asset class have gone down about 11%. We've seen reduced fundraising in the last year. But conversely, much more interest in things like private credit and infrastructure, where you do have that inflation hedge and that hedge against rising rates. So people are much more interested in those asset classes. If we then think about what we're projecting for 2023, there's obviously more caution in the market with everything that's going on in the macro environment. I think we will still see some deal flow, especially on secondaries. So GP-led secondary activity, we're expecting to still be strong because GPs do need to develop some liquidity within their portfolio. But in general, I would have thought activity will be still fairly muted this year.
Do you feel that not just private equity, but alternative asset managers in general have adjusted their valuations to, I guess, the new world?
That's a good question. In fact, Stefan and I were having a bit of a Barney about this in the conference room earlier, so maybe he can chip in. I think you've got that difference between psychological impact of GPs not really wanting to write down their portfolio. They spend a lot of time, effort, money. They love their assets like their children. They really don't want to write down those assets. They're also fundraising, so it's not going to really help them to write down those assets. But then on the other side, there's obviously macroeconomic factors which are pushing those valuations down. So it's where is that balance between whether they can write them down or whether they don't have to? I don't know if you have a view on that.
Yes, I think yours. All right. Hi, everyone. Yeah, we were having the conversation earlier, so maybe just a quick introduction. So I'm in charge of private equity for Europe for Ares, which is like Blackstone, one of the big multi-asset class manager, and we also have a big business in credit. So I think it's going to be a great year for private debt, simply because, as we heard this morning from the chief strategist of Allianz, I believe that we're going to be in a world where interest rates are going to stay high for a little bit longer than maybe the stock markets in January, which are very positive, make us believe. There are, especially in Europe, some structural changes in the energy and supply chains that will push inflation structurally higher for a little while. And in a world where interest rates are high for a little bit longer, then we go back to cash. You know, cash flow is, cash is king. There will be windows where public markets will reopen when the markets are good. But most of the time, we expect this year to be quite volatile and a little bit of uncertainty in public markets, and that will be very favorable to private credit. So M&A flow, I would agree with Imogen, will be a little bit lower. But what will happen is that those deals that get done, maybe the best assets first, or minority type transactions. I think a key word for private equity this year will be flexible capital and being able to structure transactions without necessarily triggering a change of control. Because today, for any new transaction, with interest rates where they are and with less competition from public markets, the cost of debt for a new deal is 2 to 3% higher. And that's math. So for any new transaction that is done, valuations on the private equity side will have to come down. And so there will be a lag. There's always a lag between private equities and public equities. But DPI, LP, will push for cash flow back to LPs, and that will push for new transactions being done. And when that happens, they will get done with debt that is more expensive and therefore less leverage and therefore lower valuation. And from there, I think it's just a matter of time before the portfolios of GPs have to admit that the valuations are not quite the same as they were in 2021. So it's going to be a transition year, and we think the key in private equity this year is flexibility. We see in our funds we're able to do both, majority and minority and structured equity transactions, and it's incredible to see in the last 6 months a change in deal flow and the interest from GPs to say, well, if I don't sell entirely my company, but I do need capital for M&A or for a debt maturity that I'd like to push, or because I'm fundraising and I need DPI, what can I do without necessarily revaluing my companies? And this year will be, I think, a big year for this.
What is the point about those minority transactions? Because I would think private equity, especially in the buyout world, is about getting control of companies, so you can make all the changes to, I guess, improve the asset.
The point is when you have, so today when you look at the M&A market, what's getting done is the prime assets. It's the healthcare, super resilient. There's no question. Even in choppy markets, those assets can get sold because there's a big consensus that they're going to be okay. But that's a minority of everyone's portfolio. There's still a lot of companies that are good, but not maybe tier one. They're tier 1Bs or tier 2, and a lot of these companies in normal times do well. And right now, there's just not enough buyers for these companies. But you don't want to sell them because it's not the best time to sell them. So then you look for a partner that can take a hybrid capital structure simply because maybe you had a bump on the road and your leverage has gone up a little bit and you can't refinance with just cash pay debt because cash pay debt is costing a lot more money than the last few years. And so you have no choice. Your leverage has gone from 5.5, 6 to 6.5, 7, and there's no more unitranche lender at 7 times. So you have to take that 1 or 2x EBITDA of hybrid capital that is non-cash pay, and then if you need more for DPI, then you push for a partner that can add value, and it's kind of a influence or co-control transactions, and you see these consortiums deal getting done, and that creates DPI, that puts oil back in the system. Otherwise, it's gridlock for the next 2 years.
Can I just pick up on that? Because I think it just talks to what Stefan was saying. 2023 and beyond, I think, for the next few years, creativity is going to be the key. And whether it's a structured equity solution or a credit solution, addressing maturities, providing add-on capital for acquisitions. What we're seeing right now is 70% of our deal activity is private equity sponsors, because of an extended expectation of hold, are looking to do more with their portfolio companies, make more acquisitions. And you can afford to pay, with synergies and make that transaction happen as long as the financing's there. So, we're very focused on that. We're actually working with a lot of publicly traded businesses, public companies, larger companies outside of private equity, companies with existing public debt structures, and doing taps in private credit to provide that financing firepower for add-on acquisitions or an extension of maturities. So the breadth of what you can do, senior capital, junior capital, minority equity, is, I think, the hallmark of what you're going to see. That's going to be the driver of activity.
Is that for those corporations? Is that because bank balance sheets are shut, or where do they come
Yeah, largely. I mean, we're talking some very large corporates, public corporates, who usually think about 2 pools of capital. There's, raise bank debt from their commercial bankers, or do a discounted share issuance. And neither of those 2 are palatable. can you do something that's different? So either private credit sleeve or non-cash pay private credit solution just gives them more optionality and starts addressing maturities. But I don't think, to be clear, that the maturity wall is going to be a big driver, unlike the GFC, because most of the maturities in European credit are towards 2026 and 27. So still some time.
Stefan, how's it about financing? How do you get the access you need at the moment? I mean, obviously, you know, there's a lot of hung debt on bank balance sheets. Financing is getting more expensive. What's your sense on that?
Sure. So we are focused in the middle market. So it's typically relatively smaller companies, and there we have access to this wonderful world of private credit. These companies, when they're a little bit smaller in size, do not require as much.
It's also more expensive.
It is more expensive, but we got used to it. But it's typically companies that don't have the size to go and raise a high-yield bond or a big loan syndicated structure. There's less competition, though, and it costs more money, so that affects the valuation, as discussed before. But financing for is not an issue at the moment. The issue is really cash flow, how we look at the valuation of companies and valuations, and it's something that we discussed as well a little bit earlier with Imogen. I just want to make sure we touched on it, because when we look at valuations of deals that get done, they don't seem to be significantly down from last year. But in the secondary market, we do see signs. We do see large discounts, and the volume was fairly low, I think, in Q4, but it starts to pick up now. These are quite high discounts from what you see in the primary market.
Yeah, I think that's an interesting point. So we haven't seen significant valuation drops in the private markets at the moment. So Q4, I think everyone was expecting, or is expecting, that there'll be valuation drops. But looking in our portfolio, I think actually it's probably going to be around flat to maybe even single digits up. But the secondaries market, who's acquiring existing assets, are definitely pricing in that expectation of valuation drops, because high-quality assets are going for 15% discounts, whereas before they were kind of small single digits to par. Lower quality tail-end positions are kind of 30% discounts. So there's obviously an expectation in the market that valuations are not where they should be. But the reality is that we haven't actually seen that play through yet. So the question is, right, well, if Q4 isn't being written down, is Q1 going to be written down? I don't know. It feels like there's more optimism in the market at the moment. So will people just hold on and say, well, we're not selling our asset anytime soon, so we don't need to write it down? And it comes back to that psychological aspect of we don't really want to write down our portfolio. So where's that balance come through? I think it's going to be interesting to see how it plays out.
And what does it mean from an investor's perspective?
Well, it means that it's a great opportunity to invest in secondaries, if I can say that, because the discounts are really large. So you can get access to positions at significant discount valuations to where they are. So I think it's really interesting.
But is it discounts being large, or is it NAVs being too high in the first place?
Well, the question is, will they actually ever write down their assets, or just hold it?
That's right. I mean, we heard it also in a prior panel. There's a big expectation that this year will be about the first wave of inflation had no impact on earnings, and companies were able to pass through. But the second wave, will maybe start to eat into margins, and therefore some expectations in markets that there will be earnings downgrades through the course of this year. And obviously, if it happens in larger or public markets, there's no reason why it would be different in private markets. And so there will be, I think, it's just a matter of time. There's always a lag. We saw a 1 to 2 year lag in the GFC between 08 and 010. But eventually, when new deals start, volume pick up and new deals start to get done with higher cost of capital and lower valuations, there comes a point where your secondary portfolio has to come to reality.
And I think it has to happen. When you are doing transactions at a 15 times multiple or a 20 times EBITDA multiple as a private equity owner, you're looking to next year's earnings to bring that down. You're expecting 10, 15, 20%. So you'd convince yourself you're paying 10, 11, 15 times forward. Now with EBITDA likely to be flat, with margin pressure coming through, that phenomenon isn't there. So the forward multiple has to ratchet down.
I have a double question. So also, I mean, we talked about fundraising. You know, it has slowed significantly, and one, you know, issue is as well that it's hard for private equity to sell assets at the moment. IPO markets are also still shut. So what are you doing about this?
So last year, the big exit was continuation funds. You know, IPO, you had some windows, but it was already quite choppy, and therefore a lot of exits were, you know, done through continuation funds. That and, you know, in the first part of last year, there was some SPACs as well. I think this is all drying up now, and DPI will come back. You know, there will be lower DPI for a few quarters, but then the pressure will be there. There's a lot of people. The agenda this year is quite full in terms of fundraising, and so people that are coming first and, you know, more eager to fundraise will have to show DPI to the LPs, because everyone's got the denominator effect. And even for good strategies, LPs are saying, I'd love to invest, but I'm way over allocated. I've got to get some cash back. So it's back to what we were discussing before, cash flow, and cash is king. You know, that's coming back big time. And that's where flexible capital and creativity, you know, to your point, Paulo, are very important. Sponsors will realize that it's not necessarily the best time to sell their assets because valuations, or there's not enough competitive tension in the markets, but they will have to find creative solutions to get some cash back, either to continue growing their companies because margins are under pressure, so you have to do more M&A, you have to expand, and that requires capital, or because you have to get some cash back to your LPs. And to do that, you know, that's where flexible capital, minority solutions, structured equity solutions are interesting, because they bridge the gap between cash pay debt, which is now capped because of interest rates, and not selling your asset and taking a markdown, to your point, Imogen.
Yeah, I think the other area is also the rise of GP-led solutions, because we're not seeing this opportunity where people can sell their assets in the market easily. You're seeing many more GPs look for a more holistic solution where they can get some more liquidity to those LPs that do want to sell out, but they also want to hold on to those assets, which they think of being the jewels in their crown. And so I think GP-led solutions are also going to be really active in 2023 as a result of some of those things.
My other question was to you on this, on the financing aspect. So if you have a portfolio company and you can't sell it, means at some point it will be difficult to service your debt. What's your experience at the moment with asset quality and basically, yeah, people servicing the debt?
Well, look, I think that's one of the drivers why valuations have to come down. If you're underwriting a capital structure that's more expensive, the leverage multiple that's sustainable, or the leverage quantum that's sustainable, has to be lower. But you also have to take a much more thematic, a much more alpha-driven approach. It's not a buy the market. None of us, you know, operate in the buy the market, beta-driven approach. You have to pick and choose your spots. We fundamentally believe in Europe, there's still some bright spots on acyclical secular growth. You know, energy transition, life sciences, ERP software, where you have recurring revenue, education, building products, infrastructure, non-risk taking insurance. These are content creation. These are areas where we are focused on. And we're still finding 5, 7, 10% revenue growth trajectories, which can help you mitigate some of that pressure on interest expense. But at the same time, they all have to be brought in. So that downside analysis, that downside sensitivity analysis, not just 0 to 5% EBITDA growth, but what if EBITDA goes down 25%? You know, make sure that that capital structure is sustainable. When you do that analysis, it usually means 7 times debt doesn't work at the front end. It's probably 5 or 4. And your equity returns that get impacted, so it goes to what we were talking about. Valuation multiples have to come down. But the deals we're doing are very attractive. I think there's a broad swathe of activity we can work on, refinancings, take this alpha-driven approach. And, you know, we're raising capital all the time. You know, we have numerous products available for family offices, institutions, high net worth, and we're tapping into just a mega trend. I think this environment will continue to accelerate that mega trend away from the 60-40 split, embrace private capital, whether it's private equity, private credit, for the first time.
So where's the value then now in private markets in one sentence? 2, I give you 2.
Cash pay debt.
Stefan?
So we don't want to sound only a negative here. History shows that when you have a time when people think differently and when you have uncertainty in the market, these are best times for private equity and for private capital in the larger sense, because these are times where you can make very interesting transactions and buy companies at good prices. There's value. Value is finally coming back in our markets in 23, and that's great news for us. Obviously, it's all about alpha, as we were saying earlier, Paolo, but it's much better than being in a fully arbitrage market where everything's super expensive because everyone thinks the same. So we're quite excited about this environment.
Imogen?
I'm going to say secondaries and listed private equity.
So you like that, yeah. As a follow-up on that point, so basically, yeah, valuations come down, but financing is higher. But it seems to me that the drop in valuations is offsetting the higher costs of financing. Is that a fair statement?
Yes, it's fair, but it means that your entry point for people deploying capital now is for the same quality business. You have two big advantages. One, you're buying it cheaper. And two, you can test in real life. You have real life diligence on how this business is dealing with inflation, with recession, and the last 2 years how it dealt with COVID. So there's a lot more information to judge whether that's a high quality business and how it evolves in a recessionary environment. And so it's a better risk return ratio for sure this year for us.
I wanted to see are there any questions from the audience? Yeah, the gentleman. Can you give me a mic? No?
Yeah, one of the underlying assumptions in your panel was that we're at the bottom. But do you think we're really at the bottom? I see the bottom when the interest rates are peaking, which is probably 6 months, 9 months from now. And then when they're peaking, that's when the recession truly starts, in my views. And it takes a bit of time. There's a lag between peaking and then the recession kicking in. So for me, the sweet spot for investing is probably more 2024 as opposed to 2023, where we're in kind of an interim period. Is that also your views? And probably it's contrasting on the panel.
Well, let me start. I mean, I do agree with you. It's what I was saying at the beginning. There's this lagging economic indicator we haven't seen the impacts of yet, with demand coming down, price inflation not coming through as strongly, where there's going to be a degree of volatility. Now, that doesn't necessarily mean you pause. I think shorter duration assets, shorter duration investments, anything that doesn't have a fixed long-term nature duration to it, is a better option. So, to clarify what I was saying, floating rate cash pay debt is probably a great place to be, because you're seeing that base rate environment, because precisely what you say. I think base rates in Europe are going to be higher for longer, and they have to defend against currency, both in GBP and euros. There's intrinsic structural inflation that needs to be addressed. There's fundamental supply shortages that need to be addressed that will keep inflation high and base rates high. So having some exposure to that base rate environment that's a benefit is a good place, where I park my money. But I agree with you. I think the volatility is here for longer. We haven't seen the peak of that volatility. We may have seen inflation start to peak, but that doesn't mean rates are coming down anytime soon.
Yeah, totally agree. We talked about the fact that this year was a transition year and valuations were coming down. We're certainly not at the bottom yet. I think it's just the beginning. But it's very hard to pick the trough or the peak, as an investor. So you want to be building your position as you're going down. Ideally, you want to be building your position faster as the peak is behind us. But that sometimes can go up very quickly. But we've had a number of shocks to the system, with COVID, with inflation last year, with starts to see recession. So investors have a lot of data to be able to assess whether the company they're going to be buying are well positioned or not. So it's all about selection and alpha, but it's certainly going to be a transition year, and it's going to take a few quarters for sure.
Yeah, I think I'd add to that. You can't market time. So you just have to invest in the best assets at the best time with the best managers, and just making sure that you're conscious of what the downside risks are and analysing your assets in that context. So I don't think it means we should stop investing. You just need to have a more cautious overlay.
Any more? Well, then maybe to wrap this up, I'm feeling slightly depressed now. So I'm not sure whether we are cautiously optimistic or just cautious. But yeah, I leave you with that. Thanks very much to the panelists, and yeah, enjoy the conference.
Thank you.